If you want to be a part of the conversation before it happens here on YouTube, click that link in the description to join the free Courtside Financial Discord. What's going on, everyone? My name's Obi and welcome back to the Courtside Financial Podcast, the podcast where we talk about business and technology. In today's episode, we're going to be talking about one of the things that I think is one of the most significant shifts in automotive history. So this episode is going to get interesting. If you're new to the channel, you already know what to do. Make sure you hit the subscribe button. Whether you're new or returning, make sure you hit the like button, notification bell icon, leave a comment down below, share the video. All your engagement really does go a long way in helping us to create content and reach a broader audience, ultimately helping more people. So without further ado, let's get into today's episode. You know, as someone who follows NIO closely, I've been watching the broader automotive market with intense interest. But today's story is not just about NIO. It's about a major shift in what was once considered the undisputed homeland of automotive excellence, Germany. Let me paint a picture for you. Porsche, yes, the Porsche we're all thinking of, just saw their Chinese sales crater by 28% in 2024. We're talking about 56,900 vehicles, down from what used to be considered their biggest market. Think about that for a second. Porsche, the premium brand that Chinese consumers once couldn't get enough of, is now watching their market position erode. But let's break down what's really fascinating. This isn't just a Porsche problem. We'll break down the German automotive trifecta. First, Mercedes-Benz delivered 683,600 vehicles in China during 2024. That's a 7% decline. And their global sales down 3% to 1.98 million vehicles. But the real story here is their EV performance. Their electric vehicle sales dropped from 23% year over year to 185,000 units. For a company that's betting big on electrification, that's a serious warning. Let's dig into what this means for Mercedes-Benz specifically. They've had to lower their profit margin twice, expecting anywhere from 7.5% to 8.5% for their automotive business. This is a company that was just hitting 14.6 return rates in 2022. That's not just a decline, that's a fundamental shift in their business model's effectiveness. Now let's talk about Volkswagen, because their story adds another layer of complexity to all of this. In 2024, they delivered about 9 million vehicles globally, down about 2.3%. But here's where it gets interesting. Their Chinese market deliveries fell 9.5% to 2.93 million vehicles. But there's actually a twist. Their sales in China increased 8.1% to 207,400 vehicles. This tells us something crucial about the market dynamics at play. The traditional auto market presence is sinking faster than these companies can grow their EV presence. Let's put things into perspective with some stock market analysis. If the market's the judge has been pretty brutal. Mercedes-Benz down 4.9% over the past year. Volkswagen down 12.9% over the past year, and Porsche down 10.9%. Now let's shift gears and talk about what's happening on the other side of the equation. The numbers coming out of China in 2024 are simply staggering. We saw total auto sales and production exceeding 31 million units, new electric vehicle sales hitting 12.866 million units, a 35.5% year-over-year increase. BYD alone delivering 4.27 million vehicles. Li Auto crossing the 500,000 unit milestone, and Deep Blue maintaining 36,000 monthly deliveries. Let's break down why this growth is happening. First, there's the policy fact. The Chinese government just introduced a new cars replacement policy with subsidies up to 20,000 RMB or yuan, which is around 2,700 US dollars. This isn't just a subsidy. It's a strategic move to maintain market momentum. Now let's dive into the numbers that really tell a story. Great Wall Motors numbers are particularly interesting. They've got a projected net profit of 12.4 to 13 billion yuan. That's about 1.7 to 1.8 billion US dollars. Year over year increase up to 85%, and operating margin improvements across the board. Now, if we shift gears, Leap Motors' story is equally as impressive. They've got expected revenues of 30.5 billion yuan, which is about 4.2 billion USD, with a growth rate of 80% year over year, and they've achieved positive net profit in Q4, which is a year ahead of schedule. Who even knew you could say something like that in the EV space, where all these companies have been vying for profitability, pushing out the timelines on profitability for so long? Here's where things get really interesting. Mercedes-Benz CEO Ola made what I can only call a remarkable statement. He called for the EU to encourage Chinese automakers to build factories in Europe. So let's think about what this means. Number one, if this were to happen, there would be some supply chain integration. Think about China's role in raw materials, high-end chip production, and component manufacturing. Number two, this would obviously promote market access. Three things to consider are the historical perspective of European entry into China, current trade tensions, of course, we always talk about those, and then the potential reciprocal market access. And then lastly, it would also foster some competitive dynamics. There comes the possibility for technology transfer, innovation acceleration, and market adaptation requirements. China exported 5.86 million vehicles in 2024, and that's a 19.3% increase. But this isn't just about volume, it's about capability. Chinese manufacturers have clearly demonstrated that they can meet international quality standards, compete on innovation, adapt to diverse market requirements, and obviously scale production efficiently. Let's think about what this means for the future of the industry. Obviously, technology is taking the driver's seat here. No pun intended, but it's going to be about things like battery innovation, software integration, connected car capabilities, and autonomous driving development. Number two, we're kind of seeing a market evolution play out right under our noses. The Germans really aren't selling their traditional ICE vehicles in China anymore. They're on the decline. There's changing consumer preferences, price point competition, brand value transformation, and service integration as well. Third thing that we're seeing change and are going to continue to see change is the industry structure. We're going to see an emphasis on partnership dynamics, R&D focus areas, and of course manufacturing location strategies. The tariffs are going to be really big on that last piece. So there's several critical challenges for traditional automakers if it hasn't already been made clear. Number one is they really have to work on their brand value proposition. They've got to redefine luxury, focus on technology integration, focus on their price to value proposition as well, and obviously provide a great consumer experience. It's not just about a badge anymore. Secondly, they've got to work out their manufacturing strategy so that it works out in the best needs of the business. They've got location decisions to work out, scale economics, supply chain integration, and technology adoption. Whether they invest and make their own, or just, buy it from someone who's already doing it and doing it the right way and has spent the past decade or so working on technology that's needed here. Third is something that they have to do and put more of a focus on, but really everyone has to, which is innovation. There's R&D priorities, partnership strategies, technology acquisition, and market position. Anyways, as we conclude this deep dive, it's clear that we're not just witnessing a market shift. We're seeing a fundamental transformation of the global automotive industry. The emergence of what experts are calling the Chinese era of automobiles isn't just about sales or market share. It's about who's driving innovation, who's setting the standard, and ultimately who's shaping the future of mobility. For German automakers, this presents an existential challenge. They're not just losing market share in China, they're facing a reality that their traditional advantages like engineering, brand prestige, and market experience might not be enough to get them out of. Before we wrap up, I want to emphasize that all of this isn't just about who's winning or losing today. It's about understanding where the industry is heading and how the different players are positioning themselves for the future. The questions we all should be asking here are: how will traditional players adapt their market strategy? What role will government policy play in shaping market outcomes? How will consumer preferences evolve in different markets? And what new innovations might reshape this landscape again? Anyways, that's all for today's episode of the Courtside Financial Podcast. I hope that you found this episode useful, insightful, at the very least entertaining. If it was any of those things, make sure you hit the like button, make sure you hit the subscribe button, leave a comment down below, and we'll catch you in the next installment of the CF Podcast. As always, thanks for watching. This is Obi signing off. Good night.